Welcome to Manifested Publishers. My name is Mr. Dongo. I am an economics lecturer. Today we'll be covering that is Economics August 2024 paper, question 4, and we start with Roman A. We read the question, then we put it on the board. It says this: state 5 factors that limit the success of economic integration in developing countries. I repeat, state 5 factors that limit the success of economic integration in developing countries. State 5 factors that limit the success of economic integration in developing countries. So state 5 factors that limit the success of economic integration basically in developing countries. Developing countries, first of all, are countries that are not yet developed. They're in the process of developing. And when you talk about economic integration, we talk about these countries coming together basically to facilitate trade amongst member states. And you said one of the examples of this economic integration, a given example is like the COMESA, where you find developing countries coming together in order to facilitate trade. A given example of economic integration is COMESA, where countries come together to facilitate trade amongst member states. In the quest to facilitate trade and facilitation of cooperation amongst member states, the number of factors that basically hamper such integration. And some of the factors that we know basically does that is lack of trust amongst member states. We also have a number of things that deals with political instability, probably in the continent where those developing countries are. We can also talk about the difference in currency, may also hamper such integration. But you also know that there is violation, where you find some other members may violate the agreements that are basically enforced in such integration. We can also talk about some of the reasons that why these integrations may not work is difference in the level of technology. The countries that are probably more developed in terms of technology than other countries, and so with such, they may not be able to engage in such integration. But lastly, we can talk about a number of things like external influence. You can find countries that are not within the integration actually coming in and causes mayhem in such agreements. And therefore, at the end of the day, you find that such integrations are not facilitated. We can put them on the board. Say one, lack of trust amongst the member states, lack of trust amongst the member states. Number 2, we have what we call violation of agreements. We have number 3, very important, we call it external influence. External influence. We can also have political instability, what we call political instability, within the region. Political instability within the region. And lastly, we can talk about what we call difference in currencies, what we call difference in currencies. Difference in currency. We can add one. We have that is difference, what we call difference in the levels of technology. Difference in the level of technology. That when we have difference in the level of technology, that may also hamper agreements within the integration. And that is basically how one should approach this very question. And in looking at that question, the examiner is very clear that it needs 5 points. So the 5 points meaning that each point is equivalent to 1 mark. So as you do that, you must make sure that you're within those points and you can provide extra so that you stand a chance that even if you're not in a position to get the second or you're not able to get the third, but you have an extra mark on that, then you'll be able to get the whole question. That is how we basically approach that very question. We pick it on the next question, still on question 4, Roman B. So this is what the question says. Distinguish between debt distress and debt conversion. So we put it down on the board. We put it down on the board. That is B. Distinguish debt distress and debt conversion. Distinguish debt distress and debt conversion. Distinguish the debt distress and debt conversion. One of the things that comes to our mind is when you talk about debt, we need to understand that being in a developing country, and Kenya one of the developing countries in Africa, we need to understand that one of the major policy issues is management of debt. Because you realize that these countries are not able to fund their budget, that most of their budgets are funded through debt. And so therefore, then there's need for proper debt management in such countries. And some of the terminologies when you talk about a numbers of issues pertaining to debt, we'll have what you call debt distress, and we have what you call debt conversion. To be precise, when you talk about debt distress, is inability of a country when a country is unable to fulfill its financial obligation. That is the debt distress. When a country gets to a point that is not able to fulfill its financial obligation as a result of the debt, that is what we call debt distress. And debt distress basically will lead to what we call debt restructuring, that you need to restructure the debt as a result of the distress that comes as a result of not being able to fulfill financial obligation. On the other hand, when you talk about debt conversion, we are basically saying that conversion of a short-term loan to long-term loan and vice versa, where we typically we say that we typically exchange debt at sustainable discount. Exchange the debt at a sustainable discount. We can put it down and say debt distress. We say that debt distress is inability, is a country inability to fulfill the financial obligation. That is what we call a debt distress. And debt restructuring, and therefore debt restructuring, is required, and therefore debt restructuring is required. You get to a scenario where you are so much faced with the debts that you are not able to fulfill your financial obligation, and therefore what you call the restructuring of debt basically will be necessary in such circumstances. Then we proceed to what you call debt conversion. Debt conversion. What you call the debt conversion. So when you talk about When you talk about debt conversion, we basically say refers to the conversion, refers to the conversion, refers to the conversion, conversion of short-term debt, debt to long-term debt, conversion of short-term debt to long-term debt, and vice versa, conversion of the short-term debt to the long-term debt, and vice versa. Or we can basically say that exchange of debt, what we call exchange or stroke exchange of the debt, we say stroke exchange of the debt, typically to a sustainable discount, typically to a sustainable discount. That is what we call a debt conversion. That is what basically we call a debt conversion. And very important to understand again on these very questions that we have, very important to understand is that if the marks is allocated 4, it therefore implies that once you define the debt distress, that should account for 2 marks, and debt conversion 2 should also account for the 2 marks. That should also account for the 2 marks. And that's a question that is doable and manageable. And if you look at this, this is one of the areas that actually affect, is one of the emerging issues, especially to the developing countries, and is one of the areas that learners need to pay attention. Because if you look at these countries that are developing, Africa and having a majority of the countries that are developing, they're faced with a number of debt issues. And so we need to give much attention to that. That is how we approach that very question. We'll pick on our next question. That is August 2024. That is question 4, Roman C. We'll read the question, that we put it on the board. Outline 6 method that may be adopted to clear external debt in developing countries. Outline 6 methods that may be adopted to clear external debt in developing countries. We raised and said that debt is a major policy issue, meaning that debt is a factor that needs to be considered. We said majorities of these countries that are in developing world rely mostly on debt. Why that? The reason is that because they're not able to fund their budgets using their own sources of revenue. And so they have to rely on debt that is basically from developed countries in order to fund their budget. So the examiner clear is asking us, how do we get to reduce? What are some of the methods that we get to clear external debt? Because these obligations actually affect the growth of a country. So we can put that on the board. Outline, that is C for C. Outline 6 methods. Outline 6 methods that may be adopted, to clear external debts in developing, countries, something very important to understand about when you talk about debt management, those are basically touches on macroeconomics. And this is one of the areas, again, also, you're not so much limited into approaching these questions. It's not limited to what you find lecturers will give, but this is a very open way if we look at our country, for example, Kenya as a case study, what are some of the ways that are very common in a country dealing with clearing external debt? One of the very common that we know as the citizens of a country is that, that the country uses, Kenya being a case study, is widening of the tax bracket. One is what we call it widening of the tax bracket, tax bracket. That essentially means that, i.e. increasing the taxes, i.e. increasing the taxes. That one of the ways that they deal with the external debt when it's too much, and how they manage it is increasing the taxes. We know that number two is what you call austerity measures. Where government reduces. Also a measure, Kenya being a case study, we know that a country is dealing with a lot of austerity measures where a country is reducing expenditures. Number two, reducing a country's expenditure, so that much of the money that is available can be used in order to pay the debt, And very important, number three, we talk about debt conversion. And debt conversions, we basically say that you can convert short-term debts to long-term as a way of reducing. So we talk about number three, what you call the debt conversion, i.e. converting short-term loans to long-term loans, and vice versa, to long-term loan and vice versa. Converting short-term loans to long-term loan and vice versa. We know that when you talk about long-term loans basically take a longer time for them to be repaid or for them to be cleared. A country may decide to dealing with this long-term loan and making them short-term so that they can clear them within the period. So we can also talk about what you call increasing government borrowing. Increasing the government borrowing. You can also increase the government borrowing in terms of internal. You can increase the government borrowing in terms of internal so that you can repay the external debt. Increasing the government borrowing, increasing the government borrowing from central bank to clear external debt. But very important, one amazing thing that a country can do. A country can also decide to seeking what you call debt forgiveness. Seeking debt forgiveness. The number of points that you can be asked where we say a country can refuse to pay debt as a way of doing away with the external debt. But the most precise and most clear way is seeking of what you call debt forgiveness. But you can also touch on what you call promoting investment so that they can have money to pay the debt. Say promoting investment so as to generate profits to pay up the debt, to pay up the external debt, so as basically to pay up the external debt. that they can promote investment within the country so that they can pay up the external debt. So they can also decide to avoid rescheduling of the loan. But that basically touches, because you can have it, touches on conversion, avoiding what you call avoiding rescheduling of the loans. We can have that as the last, avoiding. We can have it as avoiding rescheduling of the loans, so as to pay them, to pay up in time. So as basically to pay up in time, that the country can decide to avoid rescheduling of these loans so that they are able to pay them up within the required time. That is how we basically approach that question on how do we reduce, what are some of the methods that basically we use to reduce the external debts. We pick it in our next question. That is August 2024, question 4, Roman D. This is what the question says. Highlight 5 limitations of quantitative theory of money. Highlight, we put it down. Highlight, question 4D, highlight 5 limitations. 5 limitations of quantitative theory of money. Highlight 5 limitations of quantitative theory of money. So we need to understand what basically quantitative theory of money talks about. So when you look at quantitative theory of money, it basically talks about MV, which is money supply times velocity, is equals to price levels times the number of transactions times the number of transactions. A number of limitations that are basically envisioned in this theory are that the theory does not address the theory. One of the limitation, we say number 1 limitation, the theory does not address the issue, what you call the issue of interest rate. Does not address the issue of interest rate. And we basically know that interest rate is one of major policy on monetary policy. Monetary policy that we know we use to address a number of issues, in economics. We can also have number 2 limitation on this theory. The theory does not address the future. We basically say the theory does not address the future. This theory does not basically touches on the future. The theory does not address the future. Then we can also talk about is too much concerned. Number 3, we can say too much. We say too much concerned with money supply. Too much concerned with money supply, that is circulation of money supply, and ignores the demand for money. So when you look at the formula, one of the things that we have on that theory, it's concerned money supply times velocity is equals to the general price levels times the number of transactions. So this theory basically focuses on issues to do with the supply of money, but ignores what you call the demand of money. Then the theory does not explain changes in the value of money. We see that the theory does not explain the changes, what you call the changes the changes in the value of money, does not explain the changes in the value of money, and note how money does not explain. The theory does not basically that attempts to explain. This is basically a term. Attempts to explain. Say attempts to explain changes in the value of money, but does not. But not how. But not how. We say not how. We say not how money attempts to explain changes in the value of money, but not how money is in the first place determined. How money in the first place determined. Not in the first place determined. We can look at the last when we have the last on that. This theory argues that there's no general price level. Argue that 5 argues that there is no general. Argues that there's no general price levels, but rather, we say but rather series, there's no general price level, but rather series of price levels, series of change in price levels, series of change in price levels, series in change in the price levels, in the consumer price index, consumer price index. So those are basically some of the limitations that are basically attached to the theory, that is the theory of quantitative money, or theory of money. One we've talked about does not address the issues to deal with interest rate. We also know that it does not address the future. We also understand that is too much concerned on money supply and ignores the aspect of demand of money. We know that the theory attempts to basically explain the changes in the value of money, but does not address how money in the first place is determined. That is how we approach that very question. That marks the end of question 4.
Welcome to the lesson. Candidates, the subject is Advanced Auditing and Assurance. We are answering questions that were tested in August 2024. We've so far done question 1 up to question 3. Today we are moving to question number 4. Part 4A reads, auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust in the accuracy of the results and the integrity of the accounting profession. With reference to the Institute of Certified Public Accountants of Kenya ethical guidelines, justify 5 reasons why professional independence is considered important to the auditor. With reference to the Institute of Certified Public Accountants of Kenya ethical guidelines, justify 5 reasons why professional independence is considered important to the auditor. Importance. Reasons for the importance. That's a question. August 2024, question 4. A. Reasons for the importance of the auditor's independence. Now, the auditor is required to be independent, meaning that he should not be influenced by anyone. He should be free from any undue influence from the management, from the any source. He's supposed to be objective, independent, make decisions without any influence. So what do you think, candidates? So what do you think? What are the reasons for the importance of auditors' independence? Auditors' independence. Auditors' independence, candidates have said, is a freedom and the objectivity of an auditor to carry out their work without any undue influence or conflicts of interest. It means that the auditor can make impartial judgments and decisions without being swayed by personal, professional, or financial considerations. The question is, what are the reasons for the importance of the auditor's independence? The auditor is required to be free to carry out his work without undue influence, without conflicts of interest. He should be impartial and should not be swayed by financial considerations, professional or personal considerations. The auditor should ensure that he has no blood relations with the management team, because that can compromise his independence. The auditor should ensure that he has no financial interest in the company that he is auditing, because again that can influence his judgment, that can make him that can influence the way he makes decisions. So he should ensure that he does not find himself in a situation where he is not impartial. Any considerations, anything that will hinder his objectivity and independence, he is supposed to ensure that he is free from such. So what do you think that is important? And if you read the root, candidates, the root says, or the question, auditor independence is part of the foundation of the auditing profession. An independent, reliable, and ethically sound audit gives a company credibility and allows the public to trust the accuracy of the results and the integrity of the accounting information. So see, right there, candidates, you can get a point. Public trust and confidence. An independent auditor provides assurance that the financial statements are reliable and free from material misstatements, and that enhances public trust in the financial statements or financial reporting process and the capital markets. So one reason for the importance of the auditor's independence is in relation to public trust. When the auditor is independent, that boosts the trust of the public, that boosts the confidence of the public in the reliability and even credibility of the financial statements or financial reporting process. It enhances public trust. When the public know that the auditor is impartial, the auditor does not have financial interest in the company, the auditor is free to do his work that boosts public confidence and trust. Now, looking at the route again candidates, we are reading here things like an independent, reliable, and ethically sound audit gives a company credibility and allows the public of the and blah 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 blah. So another reason for the importance of the auditor's independence is in relation to objectivity. Objectivity and impartiality. There is no way an auditor can be impartial without being, first of all, independent. Independence allows auditors to maintain objectivity and impartiality in their judgment so that they can assess financial information without bias or without undue influence from the client. Do you understand? Impartial. Impartiality. The auditor can only be impartial if he is independent. So that's one reason for the auditor's independence, because in examining financial statements, the auditor is required to be objective. The auditor should be objective. The auditor should maintain objectivity. The auditor should make judgment without any bias. That can only happen if the auditor is independent. 3, independence is also important due to what we call professional skepticism. Because being skeptical from the auditing point of view means having a questioning mind. An independent mindset candidate fosters a questioning attitude which enables auditors to critically evaluate evidence and identify potential risks and errors. We know that the auditor should not believe all the information that is provided by the client. The auditor should seek to gather corroborative evidence, and that can only happen if he is independent. But when the auditor's independence is threatened, then the auditor may not maintain professional skepticism. The auditor may not have an independent mind, because he will be in a position that will hinder such or threaten his independence. So another reason for the importance of the auditor's independence is professional skepticism, fostering a questioning mind. The auditor can only maintain a questioning mind if he is independent. 4, unbiased decision making. Unbiased decision making is the reason for the importance of the auditor's independence. Independence ensures that the auditors can make unbiased decisions without fear of repercussions or without any pressure from the client. Five is also another reason is to maintain what we call professional reputation. Maintaining professional reputation. To maintain professional reputation. You can see here we've read that an auditor's independence is part of the foundation of the auditing profession. You see that? Auditor independence is part of the foundation of the auditing profession, because independent auditors are required to uphold the integrity of the accounting profession by avoiding conflicts of interest and also adhering to ethical standards. and that contributes to the overall reputation of the profession. So these are 5 reasons for the importance of the auditor's independence. 1. Public trust. 2. Objectivity and impartiality. 3. Professional skepticism. 4. Unbiased decision making. 5. Maintaining professional reputation. Have you understood? An independent, reliable, and ethically sound auditor gives a company credibility and allows the public to trust in the accuracy of the results and the integrity of the accounting profession. So part of the ISPAC ethical guidelines is the auditor's independence. The ISPAC guidelines require the auditor to maintain independence, to be independent. The auditor is required by ethical standards to be independent, to be free, and to have objectivity in carrying out their work without any undue influence or conflicts of interest. Auditors are also required to make impartial judgments and also make decisions without being swayed by personal, professional, or financial considerations. So that is part A of question 4. Part B reads, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files for the period. The following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. Now, currently, you see there is a problem with the structuring of the question, because you see in the first sentence you are reading from the question that you are a senior auditor. Then in the third sentence you are reading that the following issues have prompted the senior auditor. The question should have read that you have called a meeting. So when the question continues, then the focus is on this senior auditor. So the question cannot now read the following issues have prompted the senior auditor, because the question here is addressing the candidate. The one who is sitting the exam he should put his shoes in the legs in the shoes, or he should put himself in the shoes of the senior auditor. So the question would have read, you are a senior auditor in the audit of Jasiri Limited, a medium-sized manufacturing company. The audit of the financial statements for the year ended 30th June 2024 is almost complete, and you are reviewing the audit files. You are reviewing the audit files for the period. You have called a meeting with the client's top management to be held in a week's time. The following issues have prompted the senior auditor. Okay, so you have called a meeting with the client. So the following issues are: number 1, there were questions concerning the accuracy of the depreciation charged in the financial statements, and a preliminary investigation revealed that the computerized accounting system had failed to compute depreciation of equipment correctly, resulting to an overstatement of the depreciation value of 780,975. The book value of the equipment had been overstated by 1,128,340 shillings. The equipment value for the year ended 30th June 2024 was 7,135,725. So that's the first issue. The second issue, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to $500,000. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. 3. During the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. The management has, however, decided to reduce it to 5% on the claims that the quality assurance processes had improved, and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. So these are 3 matters required. Discuss how the auditor would be expected to treat each scenario mentioned above for the purpose of reporting. The question should have read, discuss how you would be, or discuss how you would treat. You should have read, discuss how you would treat each scenario mentioned above for the purpose of reporting. Discuss how. You, and you here is the senior auditor. You are the senior auditor. As the senior auditor, discuss how you would treat each scenario mentioned above for the purpose of reporting. Number 2, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of the Limited does not correct the misstatements. 6 marks. So there are 3 issues. There are 3 issues. Kasneb Limited is experiencing, no, that is a different issue. The first issue, there were questions. First of all, candidates, you can see that we read that the audit of the financial statements for the year ended is almost complete. So the report is yet to be finalized. So the audit is almost complete. So when the report is almost complete, you see the supervisor, the audit supervisor has done his work, and so is the report. The working papers now are on the desk of the senior auditor. And as a senior auditor, you are reviewing the audit files for the period. And there are issues that have come to attention as you are reviewing the audit files. So these issues have prompted you to call for a meeting with the client's top management. And you can see one of the issues. Number 1, there were questions concerning the accuracy of the depreciation charge in the financial statements. Depreciation charged in the financial statements. There were issues. There were questions. And a preliminary investigation revealed that this is investigation maybe carried out by the audit staff. Revealed that the computerized accounting system had failed to compute the depreciation of equipment correctly, resulting to an overstatement of the depreciation value. So the depreciation value is overstated by 780,975. The book value of the equipment had been overstated by 1,128,340. So you can see there, candidates, that the depreciation charge is overstated. The book value is as well overstated. The equipment value for the year ended 30th was 7 million. So this is a problem, and the question now is, discuss how the senior auditor you as the senior auditor would treat this scenario for the purpose of reporting. So that is the question. How would you treat this matter? And you recall the stage at which the audit is at the stage of just reviewing the audit files. Because candidates, we know that the overstatement of depreciation and the resulting overstatement of the net book value of the equipment could impact the financial statement's accuracy. That will affect the accuracy of the financial statements, obviously, because depreciation directly affects both the profit and the net asset value. B. We're answering part B. Part B, Roman 1. The auditor, obviously, candidate should assess the accuracy. The auditor has to assess the accuracy of the depreciation figures to ensure that the financial statements reflect the true and fair view of the asset value. So the first thing the auditor can do here is to identify the misstatement. Identify the misstatement. Identify the misstatement. The auditor should first of all identify the misstatement. Clearly identify the overstated depreciation and the overstated book value of the equipment. Identify it. Then, after identify, the auditor should assess the materiality of the misstatement, because the depreciation charge is overstated, the net book value of the equipment is overstated. So after identify the misstatement, the auditor should assess the materiality of the misstatement. The auditor should determine whether the misstatement is material to the financial statements. And the auditor ought to consider both the qualitative and quantitative factors. Is the misstatement material or is it immaterial? After assessing the materiality of the misstatement, then the auditor obviously should consider the impact on the financial statements. Consider the impact of the misstatement on the financial statements. Because as I said, this misstatement of depreciation charge and the misstatement of the net book value of the equipment affects both the profit and loss account and the balance sheet. So the auditor, after assessing the materiality of the misstatement, should consider the impact of the materiality in the financial statements. That is, if it's material, then what is the impact of this material of this misstatement on the financial statements? Consider the impact. Evaluate the impact on the income statement, because an expense is overstated and the impact of the overstatement of the net book value of the asset on the balance sheet. Another step, another thing to do is to discuss with the management, just as the question has suggested. Discuss with the management and request appropriate adjustment. Discuss with management and request appropriate adjustment. Because you recall, candidates, the audit report has not been issued. The audit is being finalized. So this one matter has come to the attention of the senior auditor. So before the auditor makes any opinion on the matter or the problem, because obviously it's a problem, is it not? So the auditor should, after meeting, because here we are you are seeing that we read that the following issues have prompted the senior auditor to call for a meeting with the client's top management to be held in a week's time. So within this week's time, the auditor should identify the misstatement, assess the materiality, consider the impact on the financial statements. Then the auditor, as he meets the management, should discuss this problem with the management and request for appropriate adjustment of the problem on the overstatement of the depreciation charge and the overstatement of the net book value of the equipment. Then Roman 2, Part 2, the second issue reads, at the beginning of the year 2024, the company had issued a loan to Sarah Hagoi, one of the members of the top management, amounting to 500,000 shillings. On further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial. So what do you think, candidates? And by now you should be ringing in your head is related party. The loan has been given to one of the members of the top management. A member of top management is a related party. Money is being given to a top management member. That is a related party. So that is what the examiner expects you to, first of all, acknowledge. So the auditor has to consider the implications of the undisclosed loan to Sarah Hagoi, who is a top management member. And we know the provisions, candidates of International Accounting Standards, is it number 24? Related party disclosures. The standard, that is IAS 24, related party disclosures, requires loans to key management to be disclosed in the financial statements, regardless of materiality. But here, because you see, we read that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statements because it was considered immaterial, small money. So that's why it is not disclosed. But what does the standard state? According to IAS 24. Loans to the top management. Loans to key management members require disclosure in the financial statements, regardless of materiality, because they reflect potential conflicts of interest and affect the user's perception of the management's accountability. But that's just an observation, candidates. The question is, how would you treat that scenario? This is the second scenario. This is an undisclosed loan. Undisclosed loan to a member of the management team. So number one, assess materiality. Why candidates? Because we read from this question that on further examination of the records, it was discovered that the loan had not been disclosed in the financial statement because it was considered material. That is what the management stated. But you see, professional skepticism requires that you do not take such information as gospel truth. You are supposed to have a questioning mind. Any information that you get from the client, you have to question it. You have to approach it with an element of healthy doubt. You have to doubt it. That's why, as much as on investigation we are told that the loan was considered immaterial, you are safe to assess materiality. Determine whether the loan is material to the financial statements, considering both quantitative and qualitative factors. That's the first thing to do. Number two, consider related party disclosures. Consider related party disclosures. Consider related party disclosures. That is to mean, evaluate if the loan meets the definition of related party transactions and if adequate disclosures are required. Then, of course, you may discuss the non-disclosure with management and request appropriate adjustment. Request appropriate adjustment. All right. Request appropriate adjustment. You see how easy these questions are? There are many ways, there are many points, there are many ways you can put across the way you would treat it. But you see, the assumption also could have been that the loan was approved. You see, the issue at hand is the disclosure, the non-disclosure. because related party transactions are not prohibited. What is required is disclosure. Do you get the point? So the loan was given, but there was not disclosed. On further investigation, we are told that the loan was not disclosed because it was considered immaterial. But we know, according to the standard IAS 2024, the disclosure is required regardless of the materiality. So that is the second problem. Now the third problem, during the year ended 30th June 2024, the company made a reduction on its provision for customer warranties recognized in the financial statements. During the past 2 years, the provision has been made at the rate of 10% of sales for 3 months. During the past 2 years. The management has, however, decided to reduce it to 5%. Do you see that? It has gone down from 10% to 5% on the claims that the quality assurance processes had improved, and therefore customer warranty claims were likely to reduce. Further investigations, however, revealed that warranty claims have by far remained the same as in the previous periods. Now, first of all, candidates, what is a warranty provision? The company made a reduction in provision for customer warranties. Now here you need to understand, candidates, that a warranty provision is just an accounting entry that sets aside funds to cover potential costs associated with the product warranties. Because when a company sells a product with a warranty, it is essentially promising to repair or even replace the product if it fails within a specific time frame. Do you see that? And we've seen, not some of you have bought items from, say, the supermarket. You buy electronics from the supermarket, like the iron. There is the electronic devices, refrigerators. They come with warranties, 1 year, 2 years. That means if the customer is unable to use that product within a given time because of failure, or the product requires repairs, then that means that the supermarket or the company is promising through this warranty to repair it or to replace it. You understand? So to account for the future expense, because the company is promising in future to replace or to repair, so the company has to set aside some money through the provision for the warranty. The company creates a warranty provision. Do you understand? So during the year ended 30th June 2024, the company made a reduction. So it's reducing the provision. Okay, during the past 2 years, the provision has been made at 10%. Now it is reducing from 10 to 5, and the reason is the company is arguing that quality assurance processes had improved, and therefore customer warranty claims were likely to reduce because they have improved on the quality. But you see, further investigations reveal that the warranty claims have by far remained the same. That's the problem. That is the problem. So a warranty provision is just a provision. It may be like the provision depreciation. When a company creates a provision for depreciation, a company sets aside money every year. Okay, as the asset wears out, puts aside money until the end of the economic life of the asset, when the money that is set aside is now used to replace that asset. You understand? But that's the idea. So, and that is a problem. We've seen the problem. So the question now is, how would you treat this scenario, this problem? Can I hear from you? Reduction in warranty provision. Roman 3. Reduction in warranty provision. And you see, this is reduced from 10 to 5. Understatement of liabilities, because you see that provision is a liability. So if the company is halving, it's reducing by half from 10% to 5%, that means that the company is understating the its liabilities in relation to these warranties by half. It will lead to understatement of liabilities. And that is dangerous, candidates. So, what is the first thing to do? Assess the reasonableness of the provision. The auditor should assess the reasonableness of the provision. Should assess the reasonableness of the provision. The auditor should evaluate whether the management's rationale for reducing the provision is supported by evidence and sound judgment. The auditor may also consider the impact on future periods. Consider the impact on future periods. Consider the impact of this reduction on future periods. The auditor should assess the potential impact of the reduced provision on future periods, especially if actual warranty claims remain high. And here, it is the actual, according to the information we read from the question, actual claims will remain high. It's not that what we read is likely to remain high. Why? The management has, however, decided to reduce to 5% on claims that the quality assurance processes had improved, and therefore warranty claims were likely to reduce. Further investigation, however, revealed that warranty claims have by far remained the same. You see, the warranty claims have remained the same, yet the provision has reduced. So the company has not set aside money to meet these claims where customers are maybe returning the products. The company has not set aside money, and we see that is a risk, poses a risk to the organization. The company may not be able to meet its liabilities and when they fall due. You understand? So the auditor has to consider the impact of this reduction in warranty provision on future periods. Then the third action is to discuss the concerns with management and request a review of the provision. Request a review of the provision from management. So the management may review it, it may not review it. Because the adjustment should be to make it more appropriate. More appropriate means that reduction should be done away with. It should still be 10% because that has been the case before the reduction. Review of the provision, potentially adjusting it to a more appropriate level. So you see, candidates have just been giving 3 points because I'm guided by the question. When you are faced with this question, candidates, you try and see how marks are allocated. You can see, discuss how the auditor would be expected to treat each scenario. 9 marks. That means that each scenario you should give at least 3 points. At least 3 points. And we've seen candidates, the last point is constant. That one has to happen. You have to have a discussion with management, because this is the senior auditor. The senior auditor candidates, the role of the senior auditor, the auditor was not involved in the day-to-day audit of the work. He was not involved. The auditor was not involved. The senior auditor. The senior auditor here is reviewing the audit files for the period. The audit files have been brought to his table. So the audit of the financial statements is almost complete. When the audit is almost complete, the senior auditor has to review the audit files before the report, the opinion is expressed in the final report. The senior auditor has to review the audit files. So he has reviewed the audit files and he's come across these issues. All right. So I'm saying, look at them. For those who are going to do exams, please be guided by how the marks are allocated. Then let's look at the second part of the question, which reads, propose how you would treat each scenario mentioned above in the auditor's report, assuming the management of Jasiri Limited does not correct the misstatements. Because you see, in each scenario, the second part gives a hint on what should be the answers in the first part of the question. Because at first part of the question, the matters are to just be referred to the management. because the problems are brought about by the management. Okay, the top management. So the buck stops with the top management before the auditor expresses his opinion. So assuming the management does not correct the misstatements, because these are misstatements, the question now is, propose how you would treat each scenario mentioned in the auditor's report. Let's go back to the first scenario. The first scenario, this was the problem of the depreciation charge. It's part 2 of the question. Second part of the question, we have the overstatement. So the overstatement of depreciation charge and the net book value of the equipment. These two are overstated. Depreciation charge, that's depreciation for the year, and the net book value of the equipment. Now assuming, just as we had discussed in part 1 of the question, that the auditor should discuss with management and request for appropriate adjustment. So the management is required to make an adjustment to the depreciation charge and the net book value. Now assuming that the management refuses to make the adjustment, what should the auditor do? That's the question. Issue except for qualified opinion. What is the rationale? Why would you do so? Due to non-disclosure. Because IAS 2024 requires that such a transaction be disclosed. So the report will be qualified due to the non-disclosure of related party transaction. To non-disclosure of related party transaction. The law requires that the management should disclose. The senior auditor has had a discussion with management and requested the management to disclose it. The management have refused to disclose it. So when writing the report, the auditor should qualify it, except for. Because the omission affects the integrity of financial statements. As related party disclosures provide transparency on management's transactions and relationship that might influence decision making. That is a point. Reduction in warranty. What will be your treatment of the management's refusal to review the provision from 5% to 10%? So because we had said that the auditor should request the management to review the provision warranty to bring it back from 5%